All right, hello everyone. I am just gonna wait a few minutes and let some other people hop into this call. If you were with us earlier, that was kind of a disaster. This is my first time ever going live on Facebook, so I I couldn't figure out how to get the screen share to work, and we're gonna go through some actual numbers here. So didn't want to ruin that opportunity for you guys to see the true numbers instead of just looking at my face and watching me talk to slides. So I guess on Facebook you gotta start the slideshow and share your screen before you can share your screen. You can't have your face on there at all. So that's fine. We'll go ahead and get started here. So first of all, thank you all for taking the time to talk taxes with me today. My name is Cody Goldsworthy. I am the owner of Knit CPAs, and we are known as the CPA firm for real estate professionals because we help our clients save thousands of dollars in taxes each year. My firm is based out of Grosse Pointe, Michigan, but we currently and forever will operate completely virtual. So we serve clients all throughout the U.S., based in Michigan, but I got clients in Florida, California, and everywhere in between. So, if you're interested in working with us, definitely reach out. We operate a fully outsourced tax accounting and finance solution for our clients. Sorry, I'm just stumbling all over myself, but really we try to be the go-to person for our clients. Anything from bookkeeping, payroll, tax planning, tax preparation. We also serve as a business growth advisor, especially for some of our broker clients. We're really, like I said, the one-stop shop go-to solution for clients within the real estate space. And I apologize ahead of time. I'm going to be jumping around this slide deck a little bit. This is a slideshow I put together for a large real estate brokerage I will be presenting to this Friday. So I just carved out a couple of slides I wanted to talk about here with my online community. Trying to grow my online presence, trying to do some marketing. To this point, I've basically just grown word of mouth. So really just trying to get myself out there, so to speak. So today we are going to focus on what agents can expect come April when it's time to file and pay their taxes. Whenever I bring a new agent into my firm, their initial question is always, how much do I owe? I know there's a lot of anxiety on this topic, so that is the first goal, to set some expectations for how your tax bill will probably be. And then after that, I'm going to go through some real numbers and a case study of a client of mine back in 2023. So he came to me in February of 2023, and we're just going to go over the results we were able to drive from them. If you need some help, you need help with taxes, you need help with what to expect, you need, whatever you need when it comes to accounting and finance. If you're in the real estate space, be sure to reach out to us. We'd be happy to help you. All right. So tax liability expectations. So this is really for your newer agents out there. Anyone that's been an agent for some time has already been slapped in the face with that large tax bill, especially if they're coming from the W-2 world. I cannot tell you how many times I have a new agent that comes to me having not paid in any quarterly estimates and spending their commissions like it's all theirs, just to be in shock come April when it's time to file their taxes and they realize they have a huge tax bill. So to avoid that and set some expectations, these are actual numbers I threw into my tax software. So, this is how things would shake out. So if you are a single real estate agent, so you're not married, you don't have any rentals, you don't have any other sources of income, like all you are is an agent. Let's say you make 120K 1099 commissions, and then we find $20,000 of deductible expenses. So, mileage, home office deduction, some meals, that type of stuff. You're left with $100,000 in net income. You will owe $23,000 to the IRS, $4,000 to the state of Michigan, and your total tax bill is going to be a little over $27,000. So basically a 27% effective tax rate there. And the real lesson here, right, like this isn't a terrible situation. I mean, it's not great by any means, but you're going to owe 27 grand. If you are just avoiding taxes altogether throughout the entire year and you're not paying in any quarterly estimates, you're going to pay over $2,000 in taxes, fees, and penalties. So, if this is all over your head, you don't want to deal with anything relating to taxes, just hire my firm or any other tax professional out there. Let them, pay in these quarterly estimates for you. I mean, just by avoiding that $2,000 in fees and interest, you're basically paying for a tax professional to do your tax return and pay in your quarterly estimates. The worst thing you can do is just completely ignore it all, walk into your tax preparer at the end of the year, pay whatever you pay them, $1,500 for them to do your taxes, and then also pay this $2,000 in fees. Just be proactive about this and just pay them in yourself. It's really not that difficult. Pay it into the IRS, pay it into the state if that's applicable to you. And especially with, we're in a high interest rate environment, so some of the bills I'm seeing on the interest that accrues on these fees, it gets hefty. So make sure you're getting those paid in. Another situation here, this is just ramping things up a little bit. 220 in income, minus 20, just like in the last slide. $200,000 in net income. You're gonna owe $52,000 to the IRS, about $8,000 to the state. So about 60 grand, 30% effective tax rate because you have more taxable income in that higher tax bracket. And then obviously the fees, penalties, and interest are going to increase with the more that you owe. So the more money you're making, definitely make sure you're getting those quarterly estimates paid in. All right, this is for my presentation on Friday. All right, so here's a case study, and this obviously should look very familiar. This is the last slide we just walked through. But this was basically the situation that this client came to me in last year. He's actually a local client in Michigan, but it was 2023 in March. He brought his stuff to his tax preparer. They put it into the software, and they hit him with, and he wasn't paying in quarterly estimates. So they basically said, you're going to owe $65,000 to the IRS. He went on a payment plan with the IRS because he didn't have the money saved up to pay that bill. So he went on a 7-year payment plan, which is pretty common, pretty easy to set up. And real quick too, I always suggest agents save 30% of your commissions, throw it in a savings account, because that's basically what you're going to owe in taxes if you're not paying your quarterly estimates. But again, make sure you're doing that. So this was his situation that he came to us in, and then we're going to walk through what we did in 2023 to lower his tax bill significantly. So step one is that we got him into an S corporation. He had hired some admin staff. He brought in his own leads through a marketing agency, and just some other factors that allowed us to be really aggressive with his payroll. Because what we did here is we put him into an S corporation. And when you're in an S corporation, you need to determine reasonable compensation. You actually get paid a W-2. So all your 1099 commissions go into the S corporation. Your S corporation kicks off a W-2 to you, and then the remaining amount comes to you as a distribution. Now, when you're just an LLC or a sole proprietor, you're paying $200,000. You're paying self-employment taxes, which is 15.3% on the entire $200,000. So by setting up this S corporation, we are able to only pay the self-employment taxes on the $70,000, and then the $130,000. It's still going to flow to your personal tax return, but you're not going to have to pay any self-employment taxes on it. So that got us about $14,000 in tax savings right there. And this is not like I said, this is just a self-employment tax play. Right? It's not reducing your income tax at all. You're still going to show $200,000 on your 1040, but by just carving out a piece of that as a W-2, you're going to save significantly on self-employment tax. All right, investing in real estate worth $350,000. So he was already an active investor when he came to us. The problem was that his last financial professional was not ramping up depreciation and not generating loss in those rentals. You have a significant opportunity as a real estate professional to generate losses in your rental properties and having that offset your active W-2 income. I have a lot of high earning individuals that just dreamed that they were in that situation. So you really are in an advantageous situation there when it comes to taxes. So this is assuming 100% bonus depreciation, which I think Trump is probably going to bring back. So if you bought property worth $350,000, let's say 86% of that was building value. So we take out the land, and then we say that 20% of that is eligible for bonus depreciation. That's driving a $60,000 write-off on your taxes, which generates about $14,000 in tax savings. Now, obviously, the cash outlay here, like if you were just to go buy rental real estate worth $350,000, you're going to be throwing a down payment of like $70,000 or something like that. Quick math at the top of the head. But he was a savvy real estate investor. So he used hard money lenders to purchase, to do the rehab, and then he would go to the bank and refinance the property with the mortgage. So he wasn't coming out of pocket that much. So, being a savvy investor in real estate while you're also a real estate professional, you can really get into some of these deals with low money down and then get the significant tax savings on top of it. So saved him about 14 grand in taxes just by doing a cost segregation study and bonus depreciating the items that were available to us. Next, he set up a solo 401k in his S corporation. So he invested $14,000 of his own money, so basically through his W-2. And then we had the S corporation, his company, match that 25%. So, and sorry, I got a little sidetracked there, but with a 401k, one thing to always remember too is that it's not all lost. Everyone thinks that, you throw money in a 401k and now you're just going to be buying stocks for the next however many years until you hit retirement age. But you can self-direct your 401k amounts. You can do a self-directed 401k within your company that you contribute to. Your company will match a percentage of it. You get the tax benefit of doing so. And then in a self-directed account, you can buy real estate. You can lend to flippers. You can buy land with it. You can really do, whatever you want. Now, obviously, there's a lot of rules you have to follow in terms of you not being actively involved with some of those purchases. But a lot of opportunity there. So that saved him about $4,000 in taxes. Next, he has a high deductible health plan, which we pay for out of his S corporation. And he also has a health savings account he maxed out, which you all should be doing if you're eligible to do so. You can contribute like $4,000. It reduces your tax bill. You can invest that money within your HSA, which grows tax-free. You can pull that money out for out-of-pocket medical expenses tax-free. And one thing too that a lot of people don't realize is you can, if you're having good years and you're paying for out-of-pocket medical expenses, you can just continue to save those receipts. And then, 10 years from now, you have a tough year and you need some extra cash. You can submit all of those receipts in that year and take that money out tax-free. And then, if you don't end up using it all, once you get into retirement, you can just pull the money out like a traditional IRA. So it's a pretty powerful account. I suggest everyone always has one and maxes it out if they're eligible. Alrighty. So next, this is just like I don't know, what would you call it? Just like a bucket of everything else we did, but he had a properly established S corporation with board of advisors. So he had his wife on there, his parents. So if he went home to see his parents, that's a board of advisor meeting. So he's writing it off. If he goes out to a nice dinner with his wife, they take meeting minutes. That's a board of advisors meeting. He's writing it off. And then he's also paying his child. Well, he only has one, but he's paying his child. So you can pay your child up to the standard deduction, which I don't remember off the top of my head, but it's like $14,000. And you pay your child 14 grand. You can write that off first of all as a business expense, which is going to save you like $4,000, and then you can put that money into a Roth IRA for your child. You can use that money to pay for their schooling, any childcare, clothing, whatever you want, right? It's their money at that point. But as long as you can carve out like a specific business use for your child when you do a time log, like just do things appropriately. And you can get some good tax savings. So we generated $5,000 in tax savings in this bucket, but there is a lot of opportunity in here. And did I even touch on it? Like if you have out-of-pocket medical expenses, high out-of-pocket medical expenses, children that you can pay, making sure you have your board of advisors set up, making sure that your tax professional is handling insurance premium payments out of your business. There's a lot you can do in kind of this catch-all bucket for saving money, but this is a case study. This is what we saved him kind of in this catch-all. So in total, $37,000 in tax savings, and he was not paying penalties, fees, or interest because we're issuing a W-2 each month. So he's paying in throughout the year. He's not going to get surprised or slapped in the face with any penalties, fees, or interest. So we eliminate those. Plus, he just kind of knows what to expect at year end. So if we take the penalties, fees, and interest into account, that's over $40,000 in tax savings. So, he's still a client, obviously. We've actually never had a client leave my firm, but he was just thrilled with this result, and it was great. It was great. That's kind of the passion that I have, is walking a client from point A. They're paying, what was it, like $60,000 in taxes to, paying 20, which actually I think is the next slide. Yes, it is. So this was the before picture, and then this was the after picture. So, and again, this isn't if you take into account the savings, well, with the penalties, fees, and interest, it's even more significant. But, he went from paying $64,000 one year to paying $22,000 the next year. So it was a great result. Hopefully I have the opportunity to do that for some of you. Again, if you need help, if you feel lost, you feel like there's opportunity for you to save money or grow your business, please reach out to me and my firm. We'll bring you along this journey. We'll drive great tax savings. And this is what we do day in and day out. That's why our service offerings are so vast, because I find business owners get very frustrated, and there's just a lot of information lost in translation when you have a bookkeeper or you're DIYing. You also have a business coach, you have a tax preparer. Maybe you hire a tax planner one year, and then you take that plan to your tax preparer, and they don't have the ability to perform the plan as it was written out. You don't have to worry about that when you come with us. When you join us, we take care of you, from the start to finish, without jumping through all these hoops. We will not only create that tax plan, but we're going to execute on it for you throughout the year and make sure you're in a great position. So reach out if you need anything. We're always available. Just go to my website, book a call. I would love to talk with you and see how I can help. Thank you.